Welcome. So tonight's session topic is standard versus itemized deduction. The question is, are you leaving money on the table? Now, tonight we're going to be unpacking two of the IRS's most fundamental concepts, things that are really important in their toolbox, and that is the standard deduction and itemized deductions, okay? And understanding the standard deduction and the itemized deduction is pivotal and important because they're foundational in your ability to stay on top of your tax savings and hope that check that and plan that your tax life will go the way you want it. Okay. So I wanted to start this session out a little differently, and I want to start it off with a history lesson. Okay. And I've always liked history, and I did some deep research a while ago about this, the idea of how history has shaped our tax system in the United States is very important. So I wanted to start tonight with a little history lesson, and the history lesson pertains to the standard and the itemized deduction. So, okay. So I bet many of you did not know this, and it probably wasn't taught to you in class, but um, it was in 1944, and the United States was deep into World War II, and at the time, taxes were primarily levied on the rich, and it was a taxing of personal income, but the tax law was a beast. I mean, if you think it's a beast now, it was even more beastly than before. It was even more voluminous. It was more complex, and the government, our government, was trying to raise money for the war effort. And what they decided was, hey, um, a lot of people aren't paying taxes, and we need more money, not just from the wealthy, but from the average American taxpayer. So, what can we do to make the taxpayers more compliant? What can we do to simplify things so that they don't have to go out and get a professional to help them with their taxes, even though they make a lot of money at the time? And so the government came up with the concept of the standard deduction. And what the standard deduction basically is a way to make the tax code a little more fairer, because they didn't think that just taxing the rich and the wealthy was fair, but they also wanted to make tax law easier for the average taxpayer, and then they would be more compliant, and more compliant taxpayers would pay more taxes and thus raise money for the war effort. So the standard deduction was implemented, and it was implemented as a fair way of doing things, a quote unquote simpler way of doing things. And then it was also implemented so that revenue would be raised, and it would allow for the taxpayers to file a lot easier and raise revenue. So in 1944, they put this in place, and that's when a lot of things changed. But the standard deduction was just one way of making it easier and charging and allowing the taxpayers to have a straight deduction of income directly off of the top of their income. And at the time that it was implemented, it was a 10% tax on the gross income that you made, but it was capped at $500. Can you imagine that? $500. Today's numbers are even I don't know, 15, 20 times that, but capped at $500. Obviously, over the years, the standard deduction has changed, and over the years, things have gotten more complex, and the standard deduction has grown in the amount of money that is allowed to be taken off of your income initially. Like I said, initially it was 10%, and then max at $500. Now If you're a single taxpayer, the standard deduction is $14,600 for tax year 2024, $29,200 for tax year 2024 for married couple. So you can see going from 10% or max at $500 to $29,000. Obviously, over the years, there's been a lot of changes. Okay. So the standard deduction, as a rule, had allowed the taxpayer to simplify their taxes. Okay, no no records were required, no no checking on the numbers, no receipts, no stress. A flat deduction right off the top, and that has made people, taxpayers, happy in some ways, okay? But it was like the IRS saying to the taxpayers, look, we know that there are going to be costs that you bear as a human living in the United States, and it wouldn't be fair to tax you on every dollar you make. So we're going to allow you to have a deduction for basic things that you would need in society, okay? And that's how it got started, okay? And as you know, tax laws change every year. And so over the years, the tax deduction for the standard deduction has grown. Okay. And now over 9 out of 10 taxpayers use it. It's most widely used. It's simple, it's powerful, it requires no proof. Um, it's considered a tax shield for taxpayers because they know if they don't qualify for the standard deduction, they could at least, excuse me, they don't qualify for the itemized deduction, they can at least get the standard deduction. And a lot of people think that's a win. But in my opinion, I believe that that's the easy way out. Okay. And in my tax life, and hopefully moving forward in your tax life, you will not necessarily stick with the standard deduction, but maybe go a little bit deeper, and maybe the standard deduction in some cases isn't your best move, especially if you're a homeowner, especially if you're a giver to your church or to to charitable organizations, especially if you're someone that pays high state and local taxes or have high medical bills. The standard deduction may not be the best case scenario for you. Okay. And that's where tax planning comes in. Now, now that we talked about standard deduction, you get a little bit of information and history about that. Now let's talk about itemized deductions, okay? And the real story about how itemized deductions came about. Now, let me take you back even further than 1944. Let me take you back to 1913, okay? And before 1913, the major way that the United States collected taxes and funded the government, if you will, was through tariffs. Now, isn't that interesting? Here we are in 2025, and there is a real big renewed interest in tariffs through the new administration, but tariffs aren't new. Again, before 1913, tariffs and excise taxes, these are taxes that were paid for gasoline and things like tires and the purchase of certain staples in society. Taxes were imposed and collected through excise taxes and tariffs. So here comes 1913, okay? And initially, um, personal income tax wasn't even taxed, okay? Businesses pay taxes and through tariffs and excise taxes. But in 1913, the law was ratified that first allowed individuals to pay taxes on their personal income. And that was a game changer. And that 1913, the law was actually um, um, well, not established, but started and brought about, I think, in 1909, but then was finally ratified in 1913, and that was a game changer. Okay, that law um, led us to where we are right now, where we're having our personal income taxes. Personal income taxed. So When they ratified that law and put that in place, the government was primarily looking at um, wealthy people, like I said, people that were like the Rockefellers or the Carnegies, and lived in the states and not into neighborhoods like us. But they put that law into effect, and they allowed for what the government considered a fair collection of taxes, and allowed us to um, take different items out of our taxable income, and thus the term itemized deductions. So we were able to deduct those things like your mortgage interest on your home, your state and your local taxes that you pay, charitable contributions both in cash and non-cash, medical um, medical bills that were paid out of pocket, and in some cases even medical insurance premiums, depending on who pays for them and how they are paid, are tax deductible as well. And over the years, the things that we were able to itemize have changed. Um, Back then in 1913, businesses that were operating at the time and had losses actually could take their business losses on a itemized deduction form, Schedule A, at the time. So you can see how things have changed because businesses cannot take their losses on as an itemized deduction any longer. I know for a fact that things have changed because when I first did my first tax return when I was 15, back then, you one of the things I remember was where you were able to deduct interest on credit cards. Yeah, yeah. And I know some of you guys didn't even know that that was a thing at one point in time. But yeah, we were able to um, deduct the interest that we paid on credit cards. Now, of course, at 15, I didn't have a credit card, but I was just giving you that as an example of how itemizations have changed as well as the standard deductions has changed. Okay. And so things over the years, things that we can itemize have, somebody says, bring back that credit card interest deduction. Yeah. 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 A lot of people would love that. A lot of taxpayers would love that. Absolutely. Government, not so much. But yeah, over the years, itemized deductions and things that you can itemize have changed. The itemization tally has grown bigger and grown smaller. Things are taken away from the ability to itemize. Things have been added. I think the last biggest change was a change that took place in 2017. Okay, and I sit down invariably every year with a tax preparation client that says, "Hey, I work from home, and can I deduct that?" And I say to them, "Well, you used to be able to deduct that. It was on a form 2106, and it was about unreimbursed employee expenses. And the primary use of that form in that category was when people worked from home or when they incurred an expense that wasn't reimbursed by their employer, that they could take that and put that down on a form 2106, which then fed over to the tax return and was able to be part of their um, itemized deductions. Well, in 2017, the law was ratified. The tax and the Tax Act cut. I don't know the exact name of it. Hold on a second. I'll get it. Yeah, Tax Cuts and Jobs Act of 2017, and that was implemented by the the President Trump, first President Trump administration, and then it took effect in 2018. That law is still in effect this year, but this is the last year that all those changes that they made are in effect. They took away the unreimbursed employee expenses. They took away moving expenses. They capped the sales state taxes and local taxes. They call it SALT tax. They capped it at $10,000. They made changes to how much you can deduct from homeowners' interest. Um, so I say all this to say that the itemized deductions have changed, but and more people take the standard deduction, 9 out of 10 taxpayers, but the itemizations aren't dead. Okay. You just have to be more strategic. Okay. And when I think about standard deduction versus itemized deductions, and in my tax life, I'm coming from the perspective of planning is better than in all my tax clients that I have for tax planning services. We're going to always itemize if we're able to. You have to meet the certain categories and certain amounts, but when you think about the standard deduction, which is the no-brainer, versus itemized deductions, which takes a little planning, the idea is that if you take the time and become intentional with your itemizations, you can always take that and beat the standard deduction depending on your situation, and you have the ability in a lot of cases to dictate your situation, and that's where having a true tax professional that works with you on a ongoing basis in a planning situation, in a planning relationship, versus that transactional one time a year situation. So now that you know a little bit about the standard deduction in its inception, what it's about, and now that you know a little bit about the itemized deduction and what it's about, um, let me give you an idea of what I'm talking about. Okay, when you choose to take the standard deduction, in a lot of ways you're choosing to follow along with the government. Okay, now let me pose a question right here, right now. Okay. If the government will give you a standard deduction, a set dollar amount that's based on your filing status, and you as a taxpayer, let's say working with somebody who helps you with tax planning, can get your itemized deduction number higher than your standard deduction number, which means that your itemization number is a direct dollar for dollar deduction off of your income. Which one of these things do you think the government is is promoting more? The standard deduction, which is a set number, or the itemized deduction number that you as a taxpayer have the ability to control and make higher than the standard deduction? Okay, a higher deduction means lower taxable income. Lower taxable income means a lower tax collected. Which one of these things do you think the government would prefer? Okay, if they can get you to not think and take the standard deduction, and you are paying them more money in taxes when it all shakes out, because you didn't take the time, or you didn't know, or you didn't even ask about possibly itemizing, then the government rakes in more money with the standard deduction as a whole. They would lose money if they really promoted you to take the itemized deductions and think it through. Okay, so I'm not saying it's a plot. I'm just saying, look at how things shake out. 9 out of 10 people use the standard deduction. Okay, it was promoted to taxpayers as tax simplification. Okay, but in my belief, it was um, well, it was kind of condescending, if you will. Okay, it was kind of condescending because it's like, okay, the taxpayers are so simple that we're gonna make it even simpler. We're gonna take away things like the exemptions, personal exemptions. We're gonna increase the standard deduction, and they'll just take standard deductions. We'll collect more money. It'll be easier. It'll be easier for everybody. Versus, hey, um, if they take the itemized deductions and they think things through and they plan it out and they're strategic and tactical in their mission to save tax money, we're going to lose out. Wow. Okay. So the government says, okay, let's go ahead and create even a higher standard deduction under the guise of simplification. Okay. So why does it matter? Okay. Why does it matter standard deduction versus itemized deduction? Well, I mean, obviously, as someone that's a tax professional and a tax geek, yeah, well, it matters. Okay. And as you know, I'm not against taxes. Okay. I want taxpayer money spent wisely. I think taxes are a natural progression in a society that wants to have a certain level of calmness and coolness and serenity in society. And I think when people together collectively pool their money, they can and resources, they can get more things done. Okay. The difference between the standard deduction and the itemized deduction. Standard deduction is basic compliance. Okay. Just filling out the forms. Okay. Check, 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 check. Itemized deductions is a more strategic approach. Okay. And it's really about tax reduction and not just basic compliance. Okay. Um, Now let's look at some use cases. Standard deduction. Okay. Let me give you an example. It's simple but not always smart. Here's an example. You got a standard deduction, which is a fixed amount we talked about. Okay. And is given to you every year, and it's automatic, it's easy when used. Standard deduction is maybe the safe path, and the itemized deduction is more strategic, okay, and more tactical in nature. Okay, so we got a married couple, and they're paying $12,000 in mortgage interest. That's the interest that you pay on the mortgage loan that you took out for your home. Okay, 12,000 in interest. Okay, $9,000 in state and local taxes. Those taxes usually come from real estate taxes you're paying on your home, or personal property taxes that you pay primarily for your vehicle, or personal things you have, motorcycle, a motorhome, or trailer. You'll pay personal property taxes, and then the main tax that you may pay are your withholdings that you pay to pay the state. They're called state taxes, or in some instances you might pay local taxes. In New York, the the boroughs that they call them different um, areas of New York City, they have local taxes that they take out as well. Okay, all those things are deductible when you itemize. Okay, in this case, the itemized the $9,000 in state and local taxes, and then in addition, the client took $6,000 in charitable contributions. Okay, well, that equals $27,000. So in this case, the itemized deductions are less than the standard deduction of married couple for 29,200. So in this particular case, yeah, um, at this as it stands right now, the standard deduction is better. But how about if we had a plan and we kind of had an idea that this was what we were going to have the situation initially turn out as, but because we planned and thought it out and maybe even forecasted what these numbers would be, that all we needed to do was maybe add another $6,000 of non-cash contributions. That's things like goodwill donations, Salvation Army donations, clothing, furniture, electronics donations to different charitable organizations. We added another 6,000 of those, and now we're at the 27,000 plus another six. We're at 33,000, which is now higher than the standard deduction. Okay, now we're on the road to having a greater tax savings because we have now just generated a higher deduction that goes against the income that we make. Okay, so you can see by this example, with a little forethought and a little execution of the plan, that you can reach a higher level of deductions, which bring down your income taxable. And lower taxable income means lower tax, and lower tax means more tax savings in the realm of not having to pay out more taxes, or saving money in the way of uh, getting a refund, whereas maybe you weren't getting a refund initially. Okay. What you don't know can cost you. Okay, what you don't plan for can cost you, and that's again why we want to look at each one of those options every year, and you actually want to look before the year starts and have an idea and plan for it. Okay, so the alternative to the standard deduction obviously is itemized deductions, And the way I used to teach it in my classes, it's on a scale, on a teeter totter, right? And you are gonna always take the one that is teetering in your favor, that gives you the largest amount of deduction, because the largest amount of deduction in against your income brings your taxable income down, which is the goal, and then the taxable income comes down, which means you pay a lower tax. Okay, and that is the gist of what we're talking about, and one of the main concerns in our tax life. Okay, so itemized deduction is going to be a little bit more work. Okay, but it's going to be more savings. Okay, um, it requires tracking. Okay, it requires proof if ever asked. Okay, and it requires intention. All right. Here's a couple itemized deductions that you can have. If you have a mortgage and mortgage interest, you can deduct that. State and local taxes, which you talked about, okay, can be deducted. Okay, charitable contributions. All you got to do is go to your closet, go to your basement, go to your garage, go to your shed, and grab some things that you haven't used in years. So, medical expenses. Okay, here's the thing. A lot of time, medical expenses, the deduction, the limitation that is put upon medical expenses is really high. You got a threshold of 7.5% of your adjusted gross income. Okay. And in a lot of cases, adjusted gross income is pretty high, which means 7.5% is going to be pretty high. Okay. But here's the thing, a lot of times you yourself may not qualify, but when you start adding yourself and your spouse and your dependents, and maybe a dependent that may not even be living with you, like, I don't know, a mother or father or somebody that you might be paying for to stay in an assisted living facility. Now you're getting closer and closer to that 7.5%. But if you don't think it through, if you don't ask any questions, if you just take the standard deduction that the government gives you because they believe we're not intentional, then you don't know, and you may miss out on that tax savings. Okay. All right. So some common errors that people that take the standard deduction over the itemized deductions make. They don't tally up all their deductions. Okay, a lot of cases they don't even know about itemized deductions. Okay, they only count or think about their deductions for medical expenses, and not like the example I mentioned earlier. Hey, I got dependents. Okay, at one point in time, I know exactly how that is because um, my own mother was in a facility, um, and at that point in time, she had become my wife and I. She had become our dependent because we were taking care of her in some ways, and we were able to utilize um, and get a lot of the costs that we were paying for things that were for her medical care deducted. Okay, and I mean the reality of it is I knew that those kind of things just because I lived the tax life, but obviously the average taxpayer doesn't know that because 9 out of 10 taxpayers are using standard deduction. Okay, and then people don't track their documents from their mortgage and their taxes properly that they pay, real estate taxes in particular. Okay, we'll get into real estate taxes on another lesson, because we primarily talk about federal taxes, but there are all kind of other taxes. We mentioned a few of them today. Tariffs or tax, excise taxes, um, the personal property taxes. So there's all kind of taxes, and we will over the next 4, 5, 6, 10, however many years God gives you the ability to do this, we're gonna talk about them. Okay, and they all make a difference in your tax life. Okay, and then a lot of people by default they let the tax software choose whether they take standard deduction or itemized deduction. Okay, how you gonna let some tax software choose your tax life for you? Okay, I'm of the opinion that we got to get more intentional about our tax life. Okay, so to today's principle. Okay, because I'm high on principles, and I believe the principles that we talk about are immutable, meaning that they don't change. Okay, they're a part of the the what's the word? Um, the ecosystem, if you want to call it. It's a part of our human life. These principles are immutable; they don't change, and they are applicable across all our different lives. Okay, so this week's principle is called the law of strategic repetition. Okay, and the law of strategic repetition states the things you do with consistency shape the results you get with certainty. Okay. Let me state that again. Okay. The things you do with consistency shape the results you get with certainty. Okay. Now, if you think about that, that can cut across many of our lives. Okay. And in particular, how it affects your tax life is the wealth that I talk about in these sessions. Okay. And sometimes even I don't like the word wealth because the wealth just seems so far away. Um, but it's not. Okay. And wealth comes in different packages, if you will. Okay. Not just money. But when I think about the wealth, sometimes like, it seems so far away. It seems distant. It seems, but it's not. Okay. It's not. Okay. And if we think about how long our tax life is, I just told you earlier that I did my first tax return at 15. Okay. And I'll be 63 in a few months. So I mean, I've always almost been doing taxes for almost 50 years now. Okay, you can build wealth in 50 years, but you probably won't without intentionality. And for me, I wish I would have learned the this side of my tax life a lot sooner. Okay, and part of the reason why I'm doing these lessons is maybe not 60 going on 63 like me, maybe you're 33, maybe you're 23, and somebody says, hey, I want you to check this guy out, right? He's spitting knowledge, right? He's real talk, right? And they get a jump on it at 23. Okay, by the time they're 63, they follow these principles. It's a wrap. The wealth is done. Okay, they follow these principles. They are consistent, and they will have the certainty that consistency and the law of strategic repetition brings them. Okay, all right. Here's the truth, family. Wealth doesn't just show up because you do something once. It'll show up as a result of being consistent with strategies that work in your favor, that are adaptable, that have certain tactics that we use on the ground, boots on the ground, things that you're doing every day consistently, and you'll get a certain level of certainty. Okay, tax planning. I mean, this is what it's all about. It's no different. Okay, if you consistently track your receipts, if you routinely track your income and expenses, if you periodically check your W-4, your withholdings that come on your paycheck, um, and you do that routinely and periodically throughout the year, you won't end up at the year going, oh, I didn't withhold enough. Oh my, I don't how did that happen? I don't understand. Okay. You won't say, man, I got this big fat refund, you know, and you just wasted a year of money because you let the government hold on to it for a year, and you could have put that money in an interest bearing account or a index fund or something like that, an investment that would have made you money. Okay, because you checked your W-4, and okay, all right, I'm gonna make adjustment this quarter. Okay, in my tax life. Or if you have a business, if you're paying your quarterly taxes on time and making good forecasting on your business income. And then finally, um, it's about planning. Okay, and asking the question every year: should I itemize or should I take the standard? Okay, and then if you know that you're going to be better off itemizing. Now you plan for it, and you take control, and you be intentional, and you set a goal and a plan, and then you execute that goal and the plan, so that you can have your tax life at some point in time intersect with your personal life, and now your goals are met. Excuse me, either met in general or met faster. Okay. Um, so um, when you plan, your tax life becomes predictable. Okay. Now, obviously, things happen, and there are changes in the world and changes in the tax system every year. But as long as there are incentives in our tax system, in our tax code, it goes back to another law we talked about. You got to position yourself for it. Okay. And you can't position yourself in your tax life without being intentional. Okay. So when you do things repetitiously, you're going to have a certainty or predictability that comes, and then that allows you to control your cash flow. It allows you to have a certain level of peace of mind. I can sleep at night because I'm not worried about that tax return bouncing all over the place, getting red flagged, and being audited. Okay. But you also have peace of mind because you know you're moving that much closer. Let's just say in that 50, 60, some people 70-year journey of paying taxes or being in a tax system, and you come closer to meeting your goal that much sooner. And again, it's not about always about the money, but money is a tool, and it is a staple of being a human being in this world. And I do not believe that we are here and we are put here not to be able to think things through and to plan. And in that aspect, our tax life and the money that we either save or overspend, um, we're held accountable for that at some point in time. Okay. So the tax life that most people don't talk about, um, it's not where you guess about things. Okay. Well, I'm going to recollect. You don't go home and have to remember, okay, what did I spend that on? How did I, okay, can you find that? How do I, it's not about that. It's not about guessing. It's not about scrambling. Okay. Tax time is coming. It's April 15th. Or I need an extension. And it's not about hoping. Okay. Uh, January, let's say January 1 through April 15th is like one of the most hopeful periods of every year, right? And people are just hoping that they get a big tax refund or hoping that they don't owe money or hoping that um, their tax life ends up good for that year. Very hopeful time of the year, right? And I say that because that's part of my tax life as a tax professional. Okay. And so um, when you have planning, when you have tax planning in your tax life, you have rhythm, you have pace, you have repetition, and you repeat things that work, and you have um, let's say a harvest that will provide you with certainty. Okay. Um, for the most part, we know if we go out and we plant let's say collard greens, because as a kid I planted collard greens, right? When I planted those collard greens and I came and I watered them and I cleaned around the soil and I cultivated, and then collard greens grow long. So I put the sticks in the ground, and when I planted the collard green plant seeds, I didn't expect mustard greens to come up. Okay. So in that sense, is in your tax life, if you use the law of strategic repetition and you do things, the good things, and things that you know and things that you may be advised to do on a regular basis, then you'll have the certainty to know what the outcome will most likely be. Okay, and that's what uh, tax planning and the tax life should be about. Okay, you want to reap a harvest that's certain. Okay, um, success in your tax life doesn't come from occasional effort. It comes from being intentional, strategic, tactical, having a mission, a plan, if you will, plan of action, and then moving forward consistently. Okay, and then finally, let's take some action steps. Okay, what can we do? Okay, always want to give you guys something to move forward with before the next session. Okay, how about taking a look at your tax return? And here it goes. If you're not sure whether you itemized or took the standard deduction, find your tax return. It could be in digital format, it could be in a paper return, but take a look at it and see whether you itemized or you took the standard deduction. It's usually on the first page, okay? Page 1 of the 1040. You just kind of scroll down on that page. It's more so toward the middle of the page, and it says standard deduction or itemized deductions, okay? And then in a lot of cases, the numbers for the standard deduction are on the side of that page, and you can say, okay, this was the standard deduction this year. Does this number that's on the side that tells me what the standard deduction for this year is, does it match what's over here in the column that lists the numbers? And if it doesn't, then more than likely you itemize, especially if that number is greater than the number that's over here. Okay, but that's the action item for this week. Take a look, see what's going on. Okay, and if you took the standard deduction, okay, if you want to take the next step, maybe ask why. Okay, okay, or ask a professional why. All right. The idea is we got to take action. Okay, and this is just one action. Finally, I want to say, if you want your tax life to serve your future, okay, and not just survive the present, it's time that you know what you're deducting and why. Okay, no more guessing, and the standard deduction versus the itemized deduction. It should be something that you look at every year and plan for and be intentional about, and it will affect your tax life. It does affect your tax life. Okay, and so with that, I appreciate the opportunity to talk to you guys. I'm loving these sessions. They probably go a little bit longer than I intentionally planned, but I can get in my thing when I do these things, because like I told you, I'm kind of like a tax geek. This is one of my passions, and I appreciate the opportunity, and I appreciate the forum that social media provides. Okay, so thanks, and as usual, I want to ask you to ask yourself, what's your dream?